You worked your whole life for this money. 40 years of showing up, clocking in, sacrificing vacations, skipping dinners, and doing the right thing. And now, the very first time the government forces you to take money out of your own retirement account, they hand you a tax bill that makes your jaw drop. That is not a horror story. That is happening to real retirees all across America right now. And if you are not prepared, it will happen to you too. Welcome back to Senior Pulse US. I'm so glad you're here today because what we're talking about could literally save you thousands of dollars, maybe tens of thousands. This is one of those topics that sounds boring on the surface, required minimum distributions. But the moment you understand what's actually at stake, you will never look at your retirement savings the same way again. So stay with me, because this gets real, and it gets real fast. Let's start with the basics so we're all on the same page. If you have a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts, the IRS does not let that money sit there forever tax-free. At age 73, they require you to start pulling money out every single year. It's called a required minimum distribution, or RMD. The amount is calculated based on your account balance and your life expectancy, according to IRS tables. Sounds simple enough, right? Here's where it gets dangerous. Most people think, okay, I'll just take out the required amount, pay a little tax, and move on with my life. What they don't realize is that RMD gets added directly on top of whatever other income you're already receiving. Social Security, pension, investment income, part-time work. All of it stacks. And when that stack gets too high, you cross into a higher tax bracket without even seeing it coming. Here's a real-world example. Let's say you're a retired couple. You're bringing in about $45,000 a year between Social Security and a small pension. You're comfortable. You're managing. Then your first RMD hits, and it's $28,000. Suddenly, your combined income is $73,000. You've just been pushed out of the 12% bracket and into the 22% bracket. That's not a small difference. That's a difference that costs you real money on every dollar above that threshold. And here's the gut punch. Nobody warned you. Your account statement didn't warn you. Your HR department from 30 years ago didn't warn you. And if you didn't have a financial advisor specifically watching for this, you walked right into it. But wait. It actually gets worse. Because crossing into a higher bracket isn't the only thing that can happen. There is something called IRMA, the Income-Related Monthly Adjustment Amount. And it's a Medicare surcharge. If your income crosses certain thresholds, Medicare Part B and Part D premiums go up significantly. We're talking hundreds of extra dollars every single month coming straight out of your pocket. And that RMD you just took? It could be exactly what pushes your income over that line. So now you've got higher income taxes and higher Medicare premiums. 2 hits from one withdrawal. And then there's the Social Security piece. Up to 85% of your Social Security benefits can become taxable depending on your combined income. Some retirees are genuinely shocked when they find out that their Social Security, money they paid into their entire working lives, is now being taxed because of an RMD they had no choice but to take. This is the RMD trap, and it catches people every single day across this country. So what do you do about it? You plan. And the time to plan is before you hit 73, not after. Here at Senior Pulse US, we are all about giving you the information you need to make smarter decisions. So let's talk strategy. One of the most powerful tools available to you is the Roth conversion. Before your RMDs kick in, ideally in your 60s or very early 70s, you can move money from your traditional IRA into a Roth IRA. You pay taxes on the conversion now, but after that, Roth accounts have no required minimum distributions. The money grows tax-free. Withdrawals are tax-free, and it does not count as income that can trigger IRMA or make more of your Social Security taxable. Done right, a Roth conversion strategy over several years can dramatically reduce the size of your future RMDs and save you a fortune. Another strategy worth knowing about is the Qualified Charitable Distribution, or QCD. If you are charitably inclined and you're 70 and a half or older, You can direct up to $105,000 per year directly from your IRA to a qualified charity. Here's the beauty of it, that money counts toward your RMD, but it never shows up in your taxable income. It goes straight from the account to the charity without touching your adjusted gross income. That means no bracket jump, no IRMA trigger, no added taxation on your Social Security. If you're already giving to your church, your local food bank, or any nonprofit you believe in, this is something you absolutely need to know about. There's also the strategy of spreading out your withdrawals. Some people take their first RMD as late as April 1st of the year after they turn 73. That sounds like buying time, but here's the catch. If you do that, you'll have to take 2 RMDs in the same year, because your second one is still due by December 31st of that same year. 2 RMDs in 1 year means double the income, potentially double the bracket damage. Most financial planners recommend just taking your first RMD in the year you turn 73 to avoid that pileup. And here's something that does not get talked about enough: the importance of the years between retirement and age 73. That window, if you have it, is golden. If you're not working or working very little, your taxable income is probably at its lowest point in decades. That is your opportunity to do Roth conversions at lower rates. That is your window to strategically pull money out of taxable accounts before the RMDs force the issue. The people who navigate retirement taxes successfully are almost always the ones who used that window wisely. Now look, I want to be completely straightforward with you. Everyone's situation is different. The right strategy for your neighbor might be wrong for you depending on your account balances, your other income sources, your health, your state taxes, and your goals for leaving money to your family. This video gives you the knowledge and the vocabulary to have a real, informed conversation with a financial advisor or a CPA who specializes in retirement. Please do not try to navigate this alone, and please do not wait until you get that first RMD statement to start thinking about it. The retirees who get blindsided by this are not careless people. They're hard-working Americans who trusted that the system would be straightforward. It's not always straightforward. But now you know. And knowing is everything. If this video helped you understand something that you didn't before, do this one thing: share it. Share it with your spouse, your sibling, your best friend, or anyone you know who is approaching retirement or already in it. The information in this video could save someone you love a serious amount of money. And that matters. Here at Senior Pulse US, our entire mission is to make sure you have the real information that protects your retirement, your income, and your peace of mind. Hit that subscribe button if you haven't already, and ring that bell so you never miss what we put out. We cover everything that matters for seniors in America, from Social Security to Medicare to taxes to benefits. And we're not going anywhere. Thank you so much for watching. Stay informed, stay protected, and we will see you in the next one right here on Senior Pulse US.